To be a successful investor, many will endeavor to understand the financial markets and to find the secret sauce. But sometimes it's important to look inwards. As investors, we are in the driving seat and our actions determine our investment success and not external factors. And this is largely the same for everyone. Let's talk about a report on Hong Kong investors and what we can learn from this. Welcome to another episode of Money Matters. This report was published by the Investor Education Centre in 2017, comprising both qualitative investigation and quantitative interviews to understand Hong Kong retail investors' attitudes and behaviour towards investing. I will highlight the most interesting results in this video. 3 out of 5 adults aged 18 to 70 had invested in financial products in the past year, with close to half investing in stocks. Investors held 430,000 of liquid assets on average and allocated 45% of it in investment of financial products. While the majority had long-term capital growth in mind, a significant proportion, 41%, of investors also aimed for quick profits. Almost all stock investors invested on the Hong Kong main board, with a little under half said they had invested in the Gem board. Blue chips had a 61% participation rate, whilst 38% traded small cap stocks. Blue chips saw an average investment time horizon of 3.3 years. However, investors generally held onto their stocks for less than a year. 13% of stock investors invested in IPOs in the past year. 20% of IPO investors said they sold the stocks on the first day of trading, and another 29% did so within the first week. Another 33% admitted they often did not read the prospectus at all when investing in IPOs. Investors expected an average annual return of 19% from the stock markets, with 44% expecting 20% or more return. Investment advice from friends or family was the top source of information influencing trading decisions at 86%, followed by financial websites at 71%, brokers and bank relationship managers at 63%, and then newspapers at 54%. Less than half said they referenced listed companies' annual reports, and only 20% paid attention to listed companies' corporate announcements. Those investing in funds also largely perceived funds to be a medium or low risk product, 64% and 22% respectively. Fund investors mostly regarded funds as mid to long term investments, with an average investment time horizon of 6.3 years. Despite the perceived medium to low risk level of funds, over 40% of investors expected 20% or more annual return from their fund investment. When choosing funds, the top consideration factors were fees and charges, projected returns, major risks, and historical performance. Less than half cared about product features, and only 1/3 paid attention to the underlying investments. From focus groups, investors reported that the fund fact sheets were usually referenced in the sales process by the intermediaries, but they tend to avoid the heavy text in the offer documents. And while some investors noted the importance of checking the different asset classes a fund invested in, the majority admitted they just assumed the underlying investments were as indicated by the name or theme of the fund. For example, a bond fund would mainly be investing in bonds. Riding on the bullish market in that year, 61% of investors claimed to have profited from the stock market, with an average return on investment of 13%, which nevertheless fell short of the expectation of 19% annual return. Note that the Hang Seng Index gained 27.1% in the same period, not including dividends, whilst the S&P 500 index gained 20.6% respectively. Also note that it is unrealistic to usually expect such high returns from the stock markets. Therefore, we can surmise that the investors in the focus group felt they could outperform the markets. As we can see, this was not the case, but rather falling short by a significant amount. In terms of advice, the majority subscribed to funds through face-to-face interaction with intermediaries. Many felt that they need the intermediaries to explain the product features and make recommendations to them. 83% said they usually bought funds through intermediaries, mostly bank, relationship managers, whilst 42% also used online platforms. Overall, 58% used traditional channels only, compared with 17% going for online channels only, and 25% using both channels. About 80% preferred the service of intermediaries, mostly for explaining the features and risks of different funds and making recommendations. The quarter also appreciated assessment of their risk appetite to match with suitable funds. Meanwhile, concerns over cybersecurity was also a barrier. From focus group discussions, many fund investors admitted they were unfamiliar with funds and relied on recommendations from the intermediaries when making fund choices. What can we learn from this research, and how can we improve our investment mindset and approach for more successful outcomes? I'll tie in some of my own conclusions from that of the report. In many areas in life, people want to put in the minimum effort for the greatest effect. Whether this is our studies, our fitness, our shopping. We want to ensure efficiency in our reading and research, we want to see quick physical gains, and we want the best value for the money in our purchase decisions. This is no different than our approach to investment decisions and management. No one has the time to constantly monitor the markets, trawl through reams of financial statements, and to keep up to date with all the latest breaking news. It's not realistic. We want to work smart and not hard. We want to be efficient. In other words, we want to take shortcuts. We've all heard of those stories of certain individuals making the right choice on small companies that were worthless back in the day but are now multi-billion and trillion-dollar companies today. We all want to be that hero who makes a fortune on that one stock. That's our ticket out of the daily grind. To stick two fingers up to the boss and hand in your resignation. Hell, you probably even wouldn't bother handing it in and just walk out the door, like we've seen on the movies. And achieve the ultimate dream of financial freedom. You clear your mortgage, buy that dream home by Lake Como next to George Clooney, fill the driveway with a Ferrari and Rolls Royce, and live like a baller, as the kids say. Investors' expectations are too high, as we've seen in this report, and they fall short of their expectations, even falling short of market returns. They would be better off buying a bit of everything and riding the market with a buy and hold strategy rather than timing in and out of the markets. Through their own actions, they create inferior performance than just simply riding the markets. As I often see time and time again, the investor is the problem, not the investments. Go ahead and search the story about Peter Lynch and his Magellan Fund as covered by Forbes. General retail investors simply don't have the risk appetite to buy big into one of those small and often private companies. More accurately put, they don't have the capacity for loss, meaning they cannot afford to lose the money. When we hear about these investors winning big, they often already have deep pockets and have invested in many other companies that perform poorly or have completely gone into liquidation. But we simply don't hear about these other positions that they hold. And whilst their positions seem like a big play to us retail investors, in proportion to their overall holdings, it is just a minor proportion. And they are actually diversified across a range of positions and often across different sectors and different regions, meaning their strategy is often not too dissimilar from our own. It's just that they play with much larger sums of capital. These professional investors put a lot of time and effort into research, crunching the numbers from company financial statements, and in many instances they meet with the board to talk about the future of the company. Yet, from this report, retail investors are lazy in comparison. We cannot even be bothered to look clearly into the underlying investments of a fact sheet. This is unforgivable. A highly concentrated portfolio with only a small number of positions requires additional research and care when compared to a well-diversified portfolio using a buy and hold strategy, because when one position falls big due to specific circumstances, it will hurt more by the very nature of a portfolio being highly concentrated. It also means that the investor will need to be particularly steadfast when markets fall. Their portfolio will usually suffer greater levels of short-term volatility. When their own positions fall, they either need to quickly exit from their positions or remain steady and bet against the market overreacting to the news that is making their positions fall. But I digress. Let's come back to concluding this report. Now, don't let me discourage you from having a fun account where you time in and out of the market, attempting to mitigate the market downturns and maximize on the market rallies. It certainly is exciting and a lot of fun. But when investing, you have to keep one eye on the bigger picture. What is the purpose of your investment portfolio? And don't tell me to make returns from the market. That's an idiotic answer. What excites you about the future? What motivates you to work hard at your job? What excites you about life? Sometimes it's for selfish reasons, like that dream holiday home by Lake Como. Sometimes it's a matter of duty, and you want to save and invest for your newborn child to grow up and go to Yale University. These big picture goals are meaningful and personal. They matter to you. And these big picture goals are your investment targets. Make the majority of your wealth playing a buy and hold strategy in a well-diversified portfolio to ensure that in 18 years you will have enough saved up to send your child to Yale. Don't let your ego destroy that dream and let the markets do what they do. With time on your side, you can ride out the short-term market volatility and ride the markets. Your fund account should be a very small minority of your overall investable wealth. In fact, make it a game and use your diversified portfolio as a benchmark and try to beat it. At the end of the day, we can learn from this excellent report from the IEC. I think many Hong Kong investors are ambitious, but to their own detriment, and we're not learning from our past actions and repeating our mistakes. Either that, or we run away from the problem and blame external factors for our own investment failures. Hong Kong has many excellent options for investing our income and savings. Regulation is comprehensive, and transparency is improving. I think the industry still has a lot to improve, particularly in the associated insurance industry, but we retail investors have plenty of choice at our fingertips. Whether we choose to seek professional help or go it alone, we have access to the world of investments. So, go out there, get involved, let the markets work for you. Keep one eye on the details, but keep the other eye on your bigger picture dreams. Apart from trying to beat market returns, the other two factors of investment outcome are simply how early you get involved in the markets and how much you save. Every dollar counts. I wish you all the best on your investment adventures. Thank you for joining me on this episode. Let me know what other topics you would like to hear about in future videos. If you like the video, smash the like button, subscribe, and I'll see you in the next episode of Money Matters.